You have spent your entire life inside a financial system. You use it every day. You trust it completely. But most people, including most highly educated people, have almost no idea how it actually works. Not the surface level, not the textbook version. I mean the actual mechanics, the machinery underneath. What you're about to hear is not a conspiracy theory. Every fact in this video is documented, sourced, verified, published by central banks, government agencies, and peer-reviewed academic research. The only thing that makes it shocking is that nobody teaches it. 7 facts. The real story of how money works. When you take out a loan, a mortgage, a car loan, a personal loan, you assume the bank is lending you money that other people deposited. That is not what happens. That is not what happens. When a bank approves your loan, it does not transfer existing money to your account. It types a number into a computer. That number, the loan amount, is new money, created at the moment of approval, out of nothing. This is not a theory. This is how the system works by design. And it is confirmed in plain language by the Bank of England itself, which published a paper in 2014 titled Money Creation in the Modern Economy. The first line states, quote, "The majority of money in the modern economy is created by commercial banks making loans. Not by governments, not by central banks, by commercial banks. Your bank, every time it issues a loan. The system is called fractional reserve banking. A bank is required to hold only a fraction of deposits as actual reserves. The rest can be lent out, and when lent out, becomes new deposits, which can be lent out again. $1,000 deposit, $900 lent, becomes $900 deposit, $800 lent, becomes $810 deposit, chain continues. Original $1,000 becomes $10,000 in circulation, $1,000 deposited, $10,000 created. That is the money multiplier, and it is the engine of the entire modern economy. In March 2020, the Federal Reserve reduced reserve requirements to 0%. American banks are now legally required to hold $0 in reserve against their deposits. Zero. The break was already thin, now it's gone. So banks create the money you borrow. But what about the interest you pay to get it back? That part of the story is even more unsettling. Right now, the average American household carries over $10,000 in credit card debt. $10,000 on a card charging 20% annual interest. Here is what most people do. They pay the minimum. The minimum payment feels manageable. $200 a month. You're paying. You're doing the right thing. You'll be fine. You will not be fine. According to the Motley Fool's verified calculation, a $10,000 balance at 18% interest, making only minimum payments, takes 342 months to pay off. That is 28.5 years. And the total amount paid is $24,423, more than double the original debt. You borrowed $10,000. You paid back $24,000. The extra $14,000? That went directly to the bank, for money the bank created out of nothing. Credit card companies are legally required by the Card Act of 2009 to print a minimum payment warning on every statement. It tells you exactly how long it will take and exactly how much extra you'll pay. Most people never read it. Most people never read it. Average credit card APR in the US hit a record 20.79% in 2024. The average savings account paid 0.46%. The spread, the gap between what banks charge and what they pay, is the largest in recorded history. Banks create money, then charge you for the privilege of borrowing it, for decades. But the story gets darker. Because the biggest lesson of the 2008 financial crisis wasn't about mortgages. It was about who pays when the system fails. September 15, 2008, Lehman Brothers files for bankruptcy. The largest bankruptcy in American history. $3 trillion of liabilities. Within 48 hours, the entire global financial system is on the edge of collapse. Federal Reserve Chairman Ben Bernanke later told the Financial Crisis Inquiry Commission that 12 of the 13 largest American banks were at risk of failure within a week or two. 12 of 13, the entire American banking system. 1 week from collapse. The government response was immediate. Congress authorized $700 billion through the Troubled Asset Relief Program, TARP. The money went to over 700 banks, to AIG, to the auto industry. But TARP was only the visible part. In 2011, Bloomberg Markets magazine used the Freedom of Information Act to obtain Federal Reserve records. What they found? The Fed had secretly lent an additional $7.7 trillion, $7.7 trillion, to struggling banks at below market rates. $7.7 trillion in secret Fed loans to banks, never voted on by Congress, never disclosed to the public, revealed only through a Freedom of Information lawsuit 3 years later. The 6 largest banks, JP Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, borrowed the most. And thanks to the difference between the emergency rates they received and the rates they charge customers, they collectively generated an estimated $13 billion in undisclosed profits, while still accepting TARP funds. Meanwhile, 6 million American households lost their homes to foreclosure. $11 trillion of household wealth evaporated, more than 5 times the decline of 1929. Unemployment peaked at 10.2%. Not one senior Wall Street executive went to prison for the 2008 crisis. Not one. Compare that to the savings and loan scandal of the 1980s, a far smaller crisis, after which nearly 900 executives were convicted and imprisoned. The rules of the financial system are not neutral. They reflect power. And in 2008, that power was made visible for everyone to see, for about 15 minutes, before most people went back to watching television. $7.7 trillion to the banks, foreclosure notices to 6 million families. But the most audacious fact about the 2008 crisis isn't what happened, it's what got bigger afterward. One of the stated goals of the 2008 bailout was to prevent any single institution from becoming so large that its failure could threaten the entire system. Too big to fail. The phrase entered the public vocabulary. Congress debated it. Regulators promised to address it. The Dodd-Frank Act was signed in 2010. Here is what happened instead. JP Chase, the largest U.S. bank in 2008, has roughly doubled its total assets since the crisis. Bank of America, same story. Wells Fargo, Citigroup, Goldman Sachs, JP Morgan $1.8 trillion to $3.9 trillion, Bank of America $1.8 trillion to $3.3 trillion, Wells Fargo $609 billion to $1.9 trillion. The top 5 U.S. banks now control nearly half of all banking assets in the country. In 1990, the top 5 controlled less than 10%. The Dodd-Frank Act added thousands of pages of regulation. It required banks to hold more capital, submit to stress tests, and create living wills, plans for how they would wind down in a crisis without requiring a bailout. But the fundamental structure, private banks creating money through lending, backed by an implicit government guarantee, remains exactly as it was on September 14, 2008. The lesson of 2008 was not make banks smaller. The lesson, apparently, was make them bigger so the guarantee is even more absolute. The biggest banks got bigger after being bailed out, and the interest they collect on the money they create from nothing keeps accumulating. But there's a third player in this system that most people never think about, and it might be the most powerful of all: the Federal Reserve, the central bank of the United States. Most people assume it is a government institution, an agency of the federal government, like the Treasury Department or the FBI. It is not a government agency. The Federal Reserve is a private institution. It was created by Congress in 1913, and its Board of Governors is appointed by the President. But the 12 regional Federal Reserve banks that make up the system, they are privately owned by member banks, the very banks they regulate. The Fed sets interest rates for the entire country. It decides how much money costs to borrow. It decides whether to expand or contract the money supply. Its decisions affect your mortgage, your savings account, your job, every economic outcome of your life. And it does so with extraordinary independence from elected government. The Fed chairman testifies to Congress. But Congress cannot vote to change interest rates. The president cannot order the Fed to lower them. In 1913, Congressman Charles Lindbergh Sr., father of the famous aviator, stood on the floor of the House and warned, "This act establishes the most gigantic trust on earth. When the president signs this act, the invisible government by the money power will be legalized." Whether you agree with that assessment or not, the structural fact is undeniable. The institution that controls the money supply of the world's largest economy is not directly accountable to the people it serves. And the name? The Federal Reserve has no federal money in reserve. Its balance sheet is composed of government bonds and mortgage-backed securities, assets it purchased, in large part, by creating new money to pay for them. An unelected institution controls the price of money. Private banks create it from nothing, and they charge you interest, for decades, to borrow it back. But the most personal fact in this story isn't about banks at all. It's about the money in your pocket, and what it actually is. August 15, 1971. Richard Nixon appears on television and announces that the United States will no longer exchange dollars for gold. From that moment forward, the US dollar has been what economists call a fiat currency. Fiat, from the Latin, meaning decree. It is money because the government says it is. It is valuable because we all agree it is. This note is legal tender. Historically, backed by gold from 1944 to 1971, then backed by trust from 1971 to the present. This is not a critique. Fiat currency is not inherently fraudulent, but it is worth understanding exactly what you are holding, and what history tells us about what happens when that trust breaks. Weimar Germany, 1923. Money printed for reparations. 100 trillion marks for a loaf of bread. Hungary, 1946. Prices doubled every 15 hours. Zimbabwe, 2008. Banknotes became worthless. Argentina, 2023. Annual inflation over 200%. Pesos losing half their value in a year. In every case, the mechanism was the same. A government printed more money than its economy could support. The people who suffered most held cash and had no assets. The wealthy, with real estate, foreign currency, gold, businesses, survived. Savers were destroyed. The dollar has been the world's reserve currency for 80 years. It is the most trusted fiat currency in human history. The probability of American hyperinflation is low, but the mechanism that made it possible in Germany, Hungary, Zimbabwe, and Argentina exists in the United States. It exists in every country with a central bank and a printing press. The promise has been kept. So far. Six facts. 6 windows into a system that most people use every day without understanding. The final fact brings it all together, and it's the most important one. In 1730, an Irish-French economist named Richard Cantillon made an observation that has never been proven wrong. He noticed that when new money enters an economy, it does not benefit everyone equally. The people who receive the new money first, before prices adjust, gain the most. The people who receive it last, or not at all, lose purchasing power. This is now called the Cantillon effect, and it explains, with mathematical precision, why the wealth gap between the top 1% and everyone else has widened dramatically since 1971, when the money supply was unleashed from gold. When the Federal Reserve creates new money, through quantitative easing, emergency lending, or bond purchases, that money enters the system at the top. Banks and large financial institutions receive it first. They use it to buy assets, stocks, real estate, bonds. Asset prices rise. The wealthy, who own assets, get wealthier. By the time that money works its way to ordinary wages and consumer prices, the purchasing power has already been redistributed. Workers get higher nominal wages, but pay more for housing, food, healthcare, and education. The real value transfer has already happened. Between 2020 and 2022, the Federal Reserve expanded its balance sheet by nearly $5 trillion in response to the pandemic. During the same period, U.S. billionaire wealth increased by approximately $1.3 trillion. Median worker real wages fell. None of this required anyone to break any law. No one went to prison. There was no fraud, by the legal definition. The system functioned exactly as designed. That is the most important fact in this entire video. The system is not broken. It works precisely as intended, to expand credit, to encourage asset ownership, to reward those who hold assets, and penalize those who hold only cash. The question, the only real question, is whether you understand it well enough to be on the right side of it. Seven facts. Banks create the money you borrow, out of nothing, and charge you interest to give it back. A $10,000 credit card debt can cost you $24,000 and take 28 years to clear. In 2008, banks received $7.7 trillion in secret emergency funding. 6 million families received foreclosure notices. The banks that were too big to fail in 2008 are twice as large today. The Federal Reserve is not a government agency. It is a private institution that controls the price of money for 330 million Americans. Your money is backed by nothing except the promise of a government. A promise that has been broken in similar systems dozens of times throughout history. And the system is perfectly designed, just not primarily for the benefit of people who hold only cash and work for wages. None of this means the system is evil. It means the system is a system, with mechanics, with incentives, with winners and losers. And the first step to being on the right side of it is understanding exactly how it works. That is what this channel is for. Subscribe to the Money Facts Lab. Share this episode with someone who thinks money is just money, and leave a comment. Which of these 7 facts hit you hardest? I'll see you in the next one.